just like every other instance of recession, and here's the key part, bear market for the stocks. I wanted to kind of build on this further because there's one or two times in here, like for example this, where we were cutting rates, okay, and the markets went higher. There's actually a way to screen these rate cuts and the S&P 500 or the stock market performance, right? So that we can point at these and say, well, how do we know which times when we're cutting it's going to be bearish for stocks and which times the market's going to just rally in the face of it, right? And the way you do that is by simply pulling up the 10-2 yield curve, which if you've been on this channel before, you'll be familiar with this right here, okay? And what you'll notice is every single time that these rate cuts were cuts into a slowdown and led to bear markets in the stocks, it happened and occurred against a backdrop of two things. Number one, the inverted yield curve, okay? When the yield curve inverts, goes back below zero, okay, then it reverts and accelerates. We know that this is an alarm signal, and we talk about this every weekend in the weekend's deep dive videos, right? But if you go back and screen, like I said, these sorts of times in here, okay, the yield curve wasn't inverted when we were cutting rates here. And thus, these were not cuts into a slowdown or recession with an inverted yield curve. Instead, these were cuts into normalization, a soft landing, everything is happy days, right? That is the context. That's the way you screen the difference. But at the hard right edge today, everyone is talking about these being super bullish cuts and looking out 12 months, we're going to be, new all-time highs and all this kind of thing again. But just like every other instance of recession, and here's the key part, bear market for the stocks, not only did we have an inverted yield curve, okay, but we've got the labour market deterioration as per the weekend's deep dive videos. We just had 911,000 downward revisions to the jobs. Okay, so that is recessionary, which means we can't actually look at this and say, yeah, these are cuts into normalization and a soft landing. I don't think that is the case.